All right. So where we left off in last Wednesday was we were talking about growth and free cash flow. And we defined the sustainable growth rate for a company as the return on investment times the investment rate. And we defined free cash flow as the profit after reinvestment. And we said free cash flow was key to value of a company because companies are not worth the profits. They're worth what can be returned after the profits are paid out. They're worth their free cash flows. And that free cash flow is the theoretical payout rate of the business. So therefore, when we value the operating entity, we'll value their free cash flows. So continuing on, one of the things that we're going to spend a lot of time on next week is figuring out free cash flow. So as part of the next 2 weeks, we're going to basically talk about how to convert accounting statements into economic statements so that we can calculate the free cash flow of a firm. And so what we're going to need to do is we're going to have to reorganize the income statement to get free cash flow. And that is going to get us something which we'll call cash flow from operations, which is different than the accounting version. So we'll also call it gross cash flow, minus investments in the balance sheet, which will be changes in the balance sheet to figure out the investments. And that is going to be called gross investment. So gross cash flow minus gross investment equals free cash flow. Right? So again, part of what the class is going to be is figuring out how to actually calculate the free cash flow of a firm. So to give you a preview of this, and I know we haven't gone through the calculations, but we've been talking about Royal Caribbean this semester. So what I want to show you is a formal statement of what we're going to call cash flow available to investors, CFI, which gives us the free cash flow of a company. And part of what we're going to do for the reorganization of the statements is it's going to give us the free cash flow so we can value companies, but it's also going to help us understand what's happening at a company. Because again, as a good analyst, we not only have to be able to calculate the numbers, we have to interpret the numbers and give the story that the number is giving us. Right? Matter of fact, that's going to be key to your midterm. You know, the reason why the midterm is open book, open notes is because everyone that's in this room is good quantitatively. All right? You're not going to be a finance major unless you're a good quant. So you know how to calculate the math. But the point is, do you not understand what you're calculating, why you're calculating it, and what it tells you? That's the other half. That's what makes a good analyst. You got to be able to interpret the data. Right? So here's the calculation of free cash flow. Here's the interpretation we can get. Again, everything sourced from Bloomberg. So all public data, right, that created this statement. So here's what we know. You're going to have to create one of these for your group projects. So again, we'll talk more about how to do this specifically later, but this is kind of the end result. So here's 5 years of historical cash flow for Royal Caribbean Cruise Lines during the 5-year period we previously discussed. The total sums up the 5 years. It kind of tells us what's been going on in the 5 years. So, highlights. For that 5-year period, they generated gross cash flow of about $6.9 billion. So, cash profit from selling tickets for their ships. They then reinvested, gross investment back in their balance sheet, almost $8 billion. They reinvested $7.9 billion in working capital and capital expenditures. The final part of free cash flow is any spending on acquisitions, and they did virtually none, very tiny acquisitions. So basically, free cash flow after acquisitions, negative $1 billion, which basically tells you right off the bat that they spent $1 billion more than they took in over the last 5 years. So reinvestment rate of about 115%. So right off the bat, if I don't know anything about this company, I know it's in heavy investment mode because they're reinvesting 115% in their profits, which means they're likely trying to grow their business, right? So I probably already know that even before I were to walk in and talk to the company. Now, let's continue the story. Non-operating activities. They basically spent $300 million on some asset, We don't really know what the asset is without reading through the statements or going back and looking at history. But they basically made a $300 million investment. And they put some money into having more excess cash, put money into basically a savings account. So when you take that into account, their what's called CFI, cash flow available to pay out to investors, was negative $1.2 billion. So they are $1.2 billion short of what's needed to pay investors. So that's how much money the investors have to give them, as opposed to the other way around. Now, they had to pay, now the financing side of the statement, $1.7 billion worth of dividends, or sorry, interest payments during those 5 years. Did they have enough money to make those interest payments from operations? Could Royal Caribbean afford the interest from operations? Well, their free cash flow is negative $1 billion. So there's no money to make the interest payments. So next line down, Royal Caribbean issued $3 billion worth of new debt. That should no longer be a surprise. Right? I can clearly see they needed to issue the debt to fund their investment in their business, plus to fund the interest that they already had to pay. Dividends. They paid $248 million worth of dividends, pretty much none for 2 years, and only a tiny dividend in the last year of this 5-year period. They didn't repurchase any shares during this period of time. So if you really think about their financing flows, all of this cash, the borrowed money, went to primarily pay the interest, because they didn't make enough money to pay the interest from operations because they were dumping all the cash back into growth. Everybody with me? All right. Carnival. Here's Carnival Cruise Lines. Again, same process. Where'd Carnival go? That's weird. Here's Carnival. If I accidentally deleted the rest of the module there. Here's Carnival. Same 5-year period. Now, Carnival is the largest cruise ship operator in the world, so they're much bigger than Royal Caribbean. They generated almost $18.7 billion of gross cash flow over that 5-year period of time. Carnival reinvested in their ships and working capital approximately $14.4 billion. They also did very little in the way of acquisitions, so they had $4.3 billion of free cash flow and a reinvestment rate of about 77%. So right off the bat, what's different about Royal Caribbean and Carnival? What can we see just by looking at history financially? Yeah. Yeah, Carnival's got a different view of growth. So distinguish the two. What is Carnival really doing? Well, just before we get to what they're doing with the cash, like, why might they not be growing as fast? Well, they're still doing ships. They're doing smaller ships. So they didn't make the big bet ships. But if you just think about generically, what we're seeing, go ahead. Now, they're probably trying to maintain market share, but they're not in heavy growth mode. So I'm saying they're still growing because they're putting 77% of their cash flow back into the business. But Royal Caribbean, their competitor, is putting 115%. So I'm saying is they're being a little bit more conservative. In looking at the numbers, they're compare and contrast between the two biggest cruise operators in the world. They're being more conservative about the future growth, where Royal Caribbean is going all out, and they're betting the future on growth because they're putting all their money plus more into growing. Yes? That's right. So what I'm saying is, when you come up with the next questions that you're coming up with, maybe they see a downturn in the business, maybe they're a little bit more conservative. That's exactly how the analysts make the analyst calls. So you wonder, where do these questions come from the analysts? It's not like they shake the magic 8-ball and then all ask the same questions again and again. It's, you kind of know from the story that the financials are telling you, you're trying to help fill in the blanks. And you're trying to make sure that you understand what the data is telling you, and then you verify that with management. Sometimes management won't answer. Sometimes management knows less about what you're verifying than you're asking them about because they don't really have a plan for the future. And sometimes they just, will give you the answer that you need. But that's the point. That's why you go through these analyst calls. And those questions are basically helping them understand what's happening in key areas of the business so they can fill out their models. But let's keep going. Non-operating cash flows, they actually generated about $800 million of non-operating cash flows, mainly by drawing down cash from their savings account, having $5.2 billion of cash flow available to be paid out. So again, Royal Caribbean, negative free cash flow, spent money on non-operating activities, had to borrow money. Carnival, positive free cash flow, generate even more cash for non-operating activities, has a lot of cash to pay out to investors. Now, what they do with it? Carnival borrowed $1.9 billion, Carnival paid out $1.9 billion in interest expense. They borrowed $1.5 billion of new debt. Did Carnival need to borrow the debt? Did they need to borrow it?
No.
Why not?
Because they have positive cash flow.
Yeah, because they had positive CFI and positive free cash flow. Did Royal Caribbean need to borrow the debt? Yes. Now, I'll caveat this by saying in the long run, every expense is discretionary, right? But at least in the short run, Carnival is borrowing debt not to finance their ships. Royal Caribbean is borrowing clearly to finance their ships and to finance the deficit in financing required by the investment in the ships, right? So let's go back to Carnival. Keep going. Carnival paid $3.4 billion in dividends. Carnival also bought back $1.7 billion worth of stock. 3.4 plus 1.7 is about 5.1. So if you really look at Carnival, they basically took all their cash flow and they paid it out. And then they borrowed some debt to primarily pay the interest. So here's what they really did. They changed their capital structure. Carnival probably saw during the financial crisis, they had a good credit rating, and they saw an opportunity to borrow with a decent credit rating very cheaply. And that's what they did. They borrowed very cheaply, and they took the cash proceeds, and they primarily used it to buy back their stock. Royal Caribbean did what? What did they borrow for? To build ships. So again, there's the manifestation and the story of what's really happening between those two companies. As an investor, I want to know that. And that's what I said, this is part of the story that these statements will tell us. And as I said, we just looking at the statements. We haven't even done any research or any other knowledge of the company, right? And so again, they can tell you a lot. Keep going. Very important slide this semester. Boring as this slide looks, it looks really boring. It's critical point. So, last week we talked about Company A. This company makes $100 million a year, growing at 5%, 10% ROI, 10% cost of capital. Made up company. And I'm adding on this slide Company B, which is another made up company. This company also has $100 million of annual profit, 5% growth rate, 10% cost of capital. So basically, identical risk, identical profits, identical growth rates. Which these two companies, given all the data on this slide, assuming these numbers were expected to continue and they don't change, would be more valuable and why? So looking at A and B, would they be the same? Maybe they have the same value. Would one be worth more or less? Yes.
Would B be higher because they have a higher return on investment?
Well, what did we say ultimately leads to value? What is value based on? Return on investment contributes to free cash flow. So it's actually the free cash flow. But it also is a higher return on investment. So that is a correct statement as well. But it's really the free cash flow of B that makes B more valuable than A. Because even though they have the same earnings, I can generate and pay out more cash from those same earnings to my investors. And as long as that's expected to continue for the same risk, B will be worth more. Right? Now, I want to come back to his point, but I want you to see a very clear linkage here. So, why does B have more free cash flow than A? I know we're talking about it simplistically, but why does B have more free cash flow than A? Yeah.
Does it reinvest less?
Because they reinvest less. They don't have to invest as much to get the same profits. And here's the point. Why does B have to reinvest less? Or why can B reinvest less?
Because the higher return on investment.
Because they get, back to his original point, they get the higher return on investment. The reason why I wanted to methodically walk you through this is the clearest way that I can articulate to you that free cash flow proxy is ROIC. Free cash flow is hard to calculate. It's not a GAAP standard accounting term. It's not something you just pull out of an annual report. You got to calculate it. You got to do a lot of work. ROIC is easy to calculate, and ROIC eventually becomes free cash flow. So you have two companies with the same growth prospects. The one with a higher ROIC will have more free cash flow. Now, I'll warn you that when the growth changes, then it makes it more difficult. But generally, for the same growth, you get more ROIC, you generate more cash flow, you become more valuable, assuming the same level of risk. And that's what we're seeing play out here. That B is better at what they do, so they don't have to spend as much because they're better at what they do, and they can get more cash. Matter of fact, I could have made it even more obvious. What if B invested $50 million rather than $25 million? So A and B invest the same. What would happen? B would have what? Much bigger growth because their profits would be growing at a faster rate. As a matter of fact, if they put in the same investment rate, 50%, times the ROIC of 20%, 20% of 50%, they would be growing at 10% a year. So they would have higher growth. Right? So all I'm saying is in either case, they'd have more earnings for the investment and generate more free cash flow, or they could have the same earnings and less investment and generate more free cash flow. But in either case, they're going to have more cash flow and become more valuable. And so again, free cash flow is hard. ROIC is easy, and that's why we talk so much about ROIC, because it's eventually a proxy for the free cash flow, assuming similar growth rates. Right? And when I say assuming similar growth rates, like I can make a tremendous free cash flow and not grow, and I can make a little less free cash flow but grow wildly, and that could actually end up being more valuable. But assuming similar growth rates, ROIC will differentiate more free cash flow. Make sense? All right. So continuing on, to value a business is different than valuing a project because we assume that businesses last forever and projects come to an end. Well, what that practically means is that to forecast a company, we have to forecast forever. Well, that's hard to do. So we ultimately turn to a growing perpetuity formula, which is the bottom of this page, to value companies in the long term. So if I had to predict your cash flows forever, I use the growing perpetuity to proxy that. A growing perpetuity has three components: cash flow, discount rate, long-term perpetual growth rate. Cash flow divided by R minus G was the original equation. So here's the idea. The problem with this formula is, in my mind, twofold. One, most of the value, 70% plus or minus 10% for most big companies, is in the future. It's after the first 5 to 10 years. So most of the value is the growing perpetuity formula. And 70% of the value of the company is three numbers. So one problem with this formula is we tend to oversimplify the long-term performance of the business to value the long-term performance of the business. It's just, that's part of what we have to deal with. But that's not the limitation we're going to address today. There's a second problem with this formula, which is a math problem. And it says that the internal rate of return on future cash flows equals the internal rate of return on historical cash flows. Translation, whatever you're making now, you're going to make into the future. So imagine that we apply this formula to a business that is cyclically performing at its best. We're going to overvalue the business. And we're going to always assume the business does well forever and it will never do poorly. If we apply this to a business that's not doing well at all, they'll have no upside and we'll probably undervalue the business because we won't give them any credit for improving their performance in the future using the formula. So one of the big challenges with this formula is that it exaggerates the directionality of the value of the business. So what McKinsey did to address this is they created something called the key value driver formula, KVD for short, which is the formula on the right-hand side of this slide. And all the key value driver formula is it is a reworked growing perpetuity formula. And they used some algebra to create it. So what they said was, we know that if we value a firm using the traditional perpetuity formula, free cash flow divided by R minus G, free cash flow is profit times 1 minus the investment rate. And sustainable growth is investment rate divided by ROIC. So investment rate is growth over ROIC. So again, just using those two simple substitutions, they got the formula on the right. So the formula on the right is a growing perpetuity formula. But here's why they like it. Number one, it's easier language for dealing with a company. So if I go to the company and I say, what's your free cash flow? Most companies are like, we don't even know what that means. They don't track it. It's not in the accounting systems. If I go to the company and I say, what are your profits? Well, they can give you those right away. And what's your return on investment? They know that too. So it's easier language to deal with given the systems that companies have set up. Second reason, and this is more important for us, that ROIC is incremental future ROIC. So using the original growing perpetuity formula, I can't forecast ROIC. I can only use implicitly whatever the current internal rate of return is. Here, I can set up an expected ROIC for the future, which is different than the past. So again, I can have one ROIC for my entire future, so that's still a limitation, but at least it can be different going forward than it was in the past. And that's the advantage of the key value drivers equation. So, with that in mind, intuitively, you told me that B was worth more than A. Now we want to quantify this. So using the key value drivers formula, let's value A and B. So to make it a little bit easier to see, I'm going to jump to Excel. So we have company A, we have company B. And there are 4 parts of this equation. Profit, growth, return, and what I'll call risk, or the cost of the capital. Those are really the 4 parts of the key value driver equation. That will give me the value of the firm. So using the data from this slide, both companies have $100 million a year profit. Both companies are expected to grow at 5% a year into the future. Company A has a 10% return on its investment. Company B has a 20% return on investment. And the cost of capital was 10% for both companies. So using the equation equals profit times 1 minus the growth divided by the return. Divide that by the cost of capital minus the growth rate. Company A would be worth $1 billion. And company B would be worth $1.5 billion. So what we're doing is we're quantifying it to say B is worth 50% more than A. For the same earnings and the same growth. What's another reason, just looking at the data on this spreadsheet, that B is more valuable? What's the differentiating factor? Yeah, B has the higher return on investment. So basically, we can clearly see that B is worth more because they have a higher return on investment. That's the only number that's different, and they're worth 50% more. As a matter of fact, in the real world, there's something called a price to earnings multiple. What is the price to earnings multiple of company A? This is how much I would pay for their earnings. They traded a multiple of earnings. What is their multiple? What is their price? Or their equivalent of price per share? So how much would we pay for A? We'd pay 1,000 or a billion. And then we would have profit of 100. So they would trade at a PE of 10. And they would trade at a PE of 15. That is really where multiples come in. Multiples are not some completely different topic. It's very related to the core cash flow valuation. And this is something we'll continue to talk about this semester, but the idea is if you change your valuation methodology, you don't get a different answer for the company. You have to get, there's one value for the company. Doesn't matter how you value them, there's one value for the company. And so that's the idea. If you use a multiples approach, or if you do a DCF cash flow approach, you got to get the same answer. So they're very related to each other. And that's kind of what we're seeing here, is the multiple is just the shortcut. So ROIC is the shortcut for estimating free cash flow. Multiples are the shortcut for doing a free cash flow valuation. Okay? That's why people like multiples, because multiples are easy and cash flow is hard. Right? Because it's hard to get all the cash flow data, but it's easy to get the multiple data. So, and I know the two eventually have to sync up. That's why people like multiples. But I'm telling you, if you go pro and you work for a real financial firm, you're going to do both. So I was working with a company that was selling one of their business units, and they brought in JP Morgan to help assess what the price would be as an advisor to them to figure out what to sell it for. One of the first things JP Morgan did is they started interviewing all their leadership and trying to get growth forecasts and get margin forecasts and financial forecasts. And they're like, well, aren't you just going to do the multiples? The answer is yes, we're going to do the multiples, but we're also going to assess what the multiples should be. So they looked at observable multiples in the market for similar businesses. And that was half their valuation. But the other half of the valuation is they looked at intrinsic value, the implied multiple of what their numbers said their multiple should be. And then they put the two together to figure out what a fair value to sell the business was for before they even went to shop it around. That's what they sold to leadership. That's what they sold to the board. And that's what you will do if you become an investment banker, is you have to understand that both of these eventually have to sync up. So back to this. I want to do a little simulation. What happens if growth changes? Actually, before I do that, what happens if profit doubles? Start with profit. What happens if A makes 200 million in profit instead of 100 million? But the same growth rate, same return, same risk. What would happen to the value? What would happen to the multiple? All right, so you think the value will go up by 2. What's going to happen to the multiple? Right now, they're at 10-time earnings. When they start doubling their initial profit, initial cash flow, all right. Same with business B. Triple. Triple. Everybody see that? So I'm going to ask the answer to the question. What drives multiples? Profit doesn't drive multiples. Growth and risk. These are the drivers of multiples. So that's the point. If I make the same return, I have the same risk, and I have the same long-term growth rate, I'm more valuable, but nothing about those profits themselves have changed. I'm still going to get the same free cash flows out of those future profits. And so therefore, the amount I pay for every dollar of profit doesn't change. I just have more dollars that I'm buying. So I become more valuable because I'm bigger. But what if I want to be better? What if I want those earnings to be worth more? So I don't just grow by having more dollars of earnings. I grow because every dollar is worth more. How do I make every dollar of earnings worth more? Well, what happens if A starts to grow faster? So I'll go back to the original assumptions. And A is now going to start growing at 6% versus 5%. So if their long-term growth rate is faster, what's going to happen to their value, and what's going to happen to their multiple? They'll both go up. All right, let's see how much. How about 7%? How about 8%? How about 9%? While you're thinking about this one, I'll go back to 6, and then B starts growing at 6. And I'll go to 7, and B starts growing at 7. I'll go to 8, and 8, and 9, and 9. Yes?
You have to increase one more of the other factors.
Well, so the growth is much higher, but why? What is not being valued at company A? What's their challenge? What's their problem? Yeah.
Lower return rate.
It's not just that it's lower.
Is it a seed risk?
It's the lower return equals what? It's the same as the cost of capital, the same as the risk. So think about it this way. The risk says on an opportunity cost of capital basis, I borrow at 10. I make 10. What's 10 minus 10? 0. I'm not creating any value. So all I'm doing is I'm working harder to go nowhere. Because I keep borrowing at 10 and making 10, I do more of that. It's not really creating any value. I like to call this the treadmill. And the problem is you run really fast, you work really hard, but you don't go anywhere. You're not creating any value with your growth. Yeah.
So you'd have to grow more than 10%.
No.
Or that's still
Well, you can't grow more because of the perpetuity equation. You can't grow more than your cost of capital into infinity. Because theoretically, if you did, you'd own the world. Because nobody would invest in anywhere else, just invest in you. But in any event, going back to this, so what about B? Why is B more valuable as they grow? Yes.
The returns higher than the risks of actually making something.
That's right. I borrow 10, I make 20, I want to do more of that. And it becomes exponentially better. What's the PE ratio for B? 55. What types of companies have a 55 PE in the real world? What are the companies that have incredibly high PEs? Technology firms. Or biotech firms. And what are technology and biotech firms expected to have in the future? Lots of growth, lots of return, high PEs. Right, that's what I said. There's not a dissimilarity between what we're talking about here and what you would expect to see. That's Amazon. Amazon is all about high growth, high return, expectations. What happened to Amazon last week when they reported their earnings? It wasn't as high as they thought it was. Guess what? Value goes down. What happens today when the economic manufacturing index comes out and economic activity is lower than what we thought? In other words, growth is lower than we thought. Values come down. Stock prices fall. This key value driver equation, if you understand the insights of it, will give you a lot of insight into what's happening in the real world, because this is really core to the economic decision making that people are making. I want to give you 2 more scenarios. Scenario number 3. So scenario 1 and 2, what if you grow at a 0 spread? What if you grow at a positive spread? Scenario 3, what if you shrink? Instead of growing at 5%, B says, we're going to grow 3. Growth prospects are just not what we thought. We're going to grow at a slower rate. What's going to happen to the value in PE? This is the expectations game. There's a lot of decimal places here, so I'll get rid of some decimal places. So, why did it go down? Why did the PE of B go down? Because their ROIC is still 20%. What about the lower growth? It's really the change in the expectations. I priced you based on expectations. And the expectation said, I assume you're going to grow 5% and make a 20% return. I realize you're only going to grow 3% and still make a 20% return, but you're going to have a lot less of those 20% projects. So therefore, you're just not as valuable. Apple. That's the painful price adjustment that Apple is experiencing today. Because the market, and why the market didn't figure this out a while ago, is now realizing that, oh no, Apple can't keep growing at 20% forever. And we thought they could. And then they woke up one day and said, well, I guess we got to cut their share price. So we went from $750 to $400 very painfully as Apple was reporting record earnings and everybody's saying, what the hell's going on here? And it had to do with the fact that people were waking up the fact that they can't keep growing 20% a year. And it's a law of large number effect. Because when you get to $150 billion in revenue, growing 20% a year is next to impossible. So that's what you're doing now. You're seeing a more realistic expectation of growth for a mature company. And what I'm saying is this shouldn't have come as a shock to so many people. And this is the problem I have with Wall Street. Wall Street almost goes like 2 years with blinders. So whatever you're doing now, you're going to do forever. And they don't assume that you're ever going to slow down. And that's why you see these companies go straight up, and it's almost like they explode, and then there's a painful readjustment because they go, oh no, they can't really realize this growth, and then they basically see the painful readjustment. So that's what you got to be careful of when you invest in the real world, because it's when those institutions switch, and they kind of flip a switch, and to go to the lower growth mode, the stock's price adjusts. And to some degree, that's what I feared would happen to Amazon, and that could be what's happening to Amazon right now. Now again, Wall Street, they have ADD. So if Amazon reports more growth soon, then they'll forget that they had a bad quarter. Because again, we're still trying to predict the future. Lower growth, 2%, 1%. Less growth, less PE. Final scenario. What if A had a negative spread? Their ROIC was 8%, their cost of capital was 10%. What happens if they grow? What happens to their value? Yeah. Yeah, so, sorry about that. So basically, as they grow, they're making more of those negative spread investments, and the end result is they're destroying value essentially at a faster rate. I borrow at 10, I make 8, I do more of it. Right? That's bad. So what do you advise company A to do? Stop growing. So instead of 6%, by the way, they grow at 7%, gets even worse. So what if they grow 3%? What if they grow 1%? What if they shrink 1%? Disinvest. Does growth create value? Just as a question. Yeah.
In the case of a firm with high returns,
That's right. So if you have higher returns, growth can create a lot of value. But if you have lower returns, growth can destroy a lot of value. So this is a somewhat controversial statement, just because it's not repeated elsewhere in all of your other classes at the business school. But most people say growth creates value. And the answer is it's a little bit more nuanced than that, because we're clearly showing here that there's good growth and there's bad growth. And good growth is positive spread growth. And bad growth is negative spread growth. So what we have to do is we have to differentiate growth and spread. And that's where we started the class. That's where we're going to continue to come back. It's the growth spread combination that's going to be critical to value, and we have to constantly look at the two together when we understand the values of firms, values of projects. All right, questions about any of that? Set this to where it was. All right. So I'm going to summarize everything we talked about. Let's strip out all the math. Key value drivers. There are 3. First, spread. If you don't have a positive spread in the long run, well, any one year you might be investing, But over time, if you don't have a positive spread, you can't create value. You can't keep borrowing at 10, making 8, and create value. Just there is no voodoo that's going to allow you to do that. Okay? So you must have a positive spread. Second, growth doesn't create value. Growth is an accelerant to value. If your spread is positive and you grow it, you create value at a faster rate. It's like throwing gasoline on a fire. If your spread is negative and you grow it, you destroy value at a faster rate. And if your spread is 0 and you grow it, you don't go anywhere. Just move in place. So it's like put your car in neutral and step on the gas. Engine revs, but you don't go anywhere. Right? So that's the point. When do you want to step on the gas? You want to step on the gas when you're in drive, when you can find good projects. You want to hit the brakes when you can't find good returning projects. And that really becomes key to running a business. And then here's the third factor, sustainability. Sustainability says, how long can you grow? How long can you get those good rates of return? Because it's likely not forever. Competition's going to figure it out. Markets are going to mature. Customers are going to move on to new technologies, new opportunities. So at what point does the life cycle get into decline stage? At what point does my product become obsolete? At what point do my peers figure out how to do it as well or better than I do and cause my returns to start coming down? So I'm just telling you is if you believe iFixit, the manufacturing cost of an iPhone is around $220. The price, average selling price of an iPhone is above $700. The markets on these phones are incredible. How long is that really going to last? And I think we're naive if we think they're going to sell 50 million headsets, making a $500 profit margin forever. And that's what the analysts are worried is starting to come to an end at Apple, because you know what? Samsung makes a pretty darn good phone, and it's cheaper. And so they're willing to accept a little less margin. And as people start going to those phones, how long can Apple maintain its price premiums on it? Right? So that's the point. It's not saying they don't have a price premium. How much, how long, we have to put into our equation. That's the other uncertainty that we have to evaluate for a company. But these become the key drivers and key principles of value. By the way, back to spread, there's a couple sub-drivers. Spread is ROIC and the cost of capital, so return and risk. And, talked about this last week, return on investment is margin and cycle time. So what really drives value for a company? Margin, cycle time, risk, growth, sustainability. Those are the 5 factors that if we really want to do analysis on any company, that we have to start and end with, because that is going to tell us the story. And in order to tell that story, we're going to put the data into that economic format that helps map to this story. Questions about any of this? All right. So these are a little bit smaller. Last week, or actually a week and a half ago, I was working with a publicly traded defense and aerospace company called Excelis. They're based in near Reston. You can see them on the Dallas Toll Road. The Dulles Toll Road. If you're going to the Dulles Airport, there's signs over there, like a couple buildings near Reston Town Center. And basically, they were a spin-off of ITT. So a few years ago, ITT took their defense business, they spun it off, they renamed themselves Excelis. They've been publicly traded now for a few years, and they're about a $5 billion publicly traded company. And when I was there, their head of investor relations was actually in the room, and she said that she had a report, because they track this very much, that their PE ratio was trading at a discount to the industry. So basically, the average PE of Excelis is a little bit lower than the average PE of the rest of the defense and aerospace peers. And I took it upon myself to explain why. Like, why would the market trade you at a slightly lower PE ratio? So before I even walked into the room, I knew it would be one of 3 reasons. What were the 3 reasons? That Excelis could have a lower PE than the defense and aerospace industry.
Lower spread.
They could have a lower spread, which break the two concepts of spread. They could have a
Lower return,
lower return on investment going forward, or
higher risk.
higher cost of capital going forward, or lower expected growth rate. I knew it was one of those three things because I know the formulas, and you will now know this. So the question was figuring out which one or combination thereof is the market putting together to give them a lower return. Then I started reading the analyst reports, and it became much more obvious because the analysts that cover Excelis are worried that a good chunk of their business is tech used by soldiers on the battlefield. Well, Obama has pretty much said wars are ending by the time he's out of administration. So he's pulling all of our troops out of Afghanistan. He's pretty much pulled most of them out of Iraq. Iraq is basically saying, it's falling apart. He's like, we're not going back in. So the general feeling is that we're going to spend less on defense. Well, if I'm actually the company that's supplying stuff to people in the battlefield, communication and other gear that they don't use when they're not in wars, probably going to have a less of a growth rate. Right? So that was my second bias walking into the room reading the analyst reports. Is this company probably has some growth challenges? I'll go a step further. So then you go to Bloomberg. And I look up in Bloomberg, I look up the FA screen for Excelis. So first of all, start typing Excelis, US equity. And then I go to FA for financial analysis. Actually, sorry. I go to EEO for earnings estimates. I want to know about the future, not the past. So I go to EEO, and I switch to an annualized view. I want to see what the analysts say about their future. So for 2014, sales go from last year 4.92 billion to 4.75 billion to 4.66 billion. So the analysts are actually predicting this company's going to shrink. So further reinforcing, it's probably the growth that is their challenge in the industry. So the whole industry's challenged, but they're going to be challenged more than their peers, right? So here's the other thing. With the expectations, I can actually use the key value driver formula to estimate a real world PE. Okay, this isn't some academic thing that nobody actually uses. This is core to what's actually being used in the real world. So, but there is a little bit of a difference because the price to earnings multiple in the real world is price per share divided by earnings per share. Right? So for price per share divided by earnings per share, the cash flow is to the shareholders. So it's the equity cash flow. So instead of using no plat for my profit, I use net income. And specifically what's called adjusted net income or net income adjusted. And the difference between net income and adjusted net income is that analysts can take out one-time charges. Right? So it's not a GAAP standard reporting number, but adjusted net income is what Wall Street and London and the city uses because the idea is if I'm valuing into perpetuity, I want things that are recurring. I don't want to have non-recurring items in there. So I take out the non-recurring items, and that's called net income adjusted. Right? So the PE ratio that you're actually going to care about is what's called the adjusted PE ratio. Well, right now, what I can do for the PEs, I'll just go to a different screen real quick, is I can look at Bloomberg peers for Excelis, select stats, market cap weighted average, and then go to my custom template that I'd previously created and we'll show you later how to do. But here's a template of current multiples. So Excelis and all its Bloomberg peers, market PE 14.55. Their PE today 11.88. So that's the point. This is the discount. They're trading at a lower PE than the rest of the industry. Right? So now I'm trying to figure out why. So back to the earnings estimates. Net income adjusted is the earnings that I care about. Growth becomes growth in earnings per share. Return becomes return on equity. And since I'm discounting the equity cash flows, the risk becomes the cost of the equity. So I have to change what I'm putting into the formula, but it's the same formula because I'm just doing equity cash flows as opposed to free cash flow. Free cash flow is the cash flows to the debt and equity holders. That's why I use a WACC. That's why I use the ROIC, the returns to the debt and the equity holders. If I do straight cash flow to shareholders, I use income, I use return on equity, I use cost of equity, because I'm ignoring all the debt cash flows. They theoretically have to get me the same answer, but if I'm doing a PE ratio as opposed to an enterprise value to EBIT or EBITDA ratio, that's why I'm using the changes. So back to this. Net income adjusted for Excelis next year currently is expected to be, annualized basis, $307 million. Okay. Their growth, I don't know what their growth is. I'm going to put 5% as a placeholder in there, and we can always change it. Return on equity. One of the things the analysts forecast is they actually forecast return on equity. Historically, it was 34 2 years ago. It was 23 this year. 19 is expected next year. 16 the year after. So as their growth is falling, so is their expected return on equity. I need to figure out what's an appropriate return on equity for them in my valuation model. I'm going to do it simply by saying I'm going to take next 2 years, divide by 2. So 19 plus 16 is 35. Divide that by 2. Call it 17 and a half. Right? Not saying that's the rate going forward. I'm just doing a quick back of the envelope. Just to do a simple example. Cost of equity. Using CAPM, I can go to the WACC screen in Bloomberg, and using CAPM, cost of equity, 10.4%. As opposed to the weighted average cost of capital, cost of debt and equity, 9%. So I'm going to discount these cash flows to cost of equity, 10.4%. So using our model, with that data, the model would say this company is worth $4 billion and should trade at a PE of 13. Today, this company is worth market cap of $3.5 billion and trades at a PE of 11.79. The reason I was using my bias is relative to the rest of the defense and aerospace industry, we said that they were probably growth challenged. So what I'm going to do is I'm going to start revising the growth a little lower. 4%. 3.8%. And what was I trying to get to? 35 and a PE of around 11.8. So 3.7. 3.6 something, somewhere in that range. So there you go. As I said, what we're talking about here is not too different than what you're seeing playing out in the real world. So what I can really tell them is, why is your company trading at a discount to the rest of the industry? If I can kind of guesstimate what the growth is for their other peers, and I can kind of guesstimate what the return is to the other peers, I can then tell you the difference in the gap. But here's the thing, you start growing at 5% a year versus 3% a year, and you're now much closer to the industry average in terms of value. So while I was there, Cowen just initiated coverage the day before on this company, Cowen and Company, and they have an analyst who wrote a very long research report with a price target, and their price target was a buy. And basically what the Cowen analyst said was that he believes that they will be able to get to an industry average PE in the next few years. And the market has too pessimistic view on the growth of Excelis. So that's the point. It's not just the growth in 2 years. He said, here's a company I think that's going to figure it out, because they're not dumb. They know they have to figure out other places to sell their stuff, and their stuff can probably be used for either international sales or commercial sales, what are called adjacents in the industry. And basically, he thinks the market has a too pessimistic view on them right now because of the short-term painful adjustment. And he basically says when the market realizes they actually have good long-term growth prospects, they're going to switch their growth estimate, and then they're worth higher. That was his point for the PE ratio being higher in his price target. But I'm telling you, behind all that was an understanding of the key value drivers model. Question over here? Comment? Sorry. Yeah. But I guess that's the idea, is that this is what you're going to have to do for your homework assignment, by the way, this week. Is I'm going to give you a company. and you're going to have to tell me what the difference is between two companies that the key value drivers models tells you about their PEs. And then their prospects on a go-forward basis. So we're going to kind of back into some real-world numbers, just like we just did for Excelis. And that's going to be part of your homework assignment. So your homework will start on Wednesday, your first graded homework assignment, and then you'll have until Monday to complete it. But basically, this is going to be part of, there'll be more to this, but this is part of Wednesday's assignment, is to figure out and actually try and apply this to other companies using real-world data. Right? Because going back to today, when somebody said the market crashed, and somebody else said, oh, there's a manufacturing index that came out bad this morning, those two are not unrelated issues. Because using the key value driver formula, what should start ringing in the back of your mind when you hear those two stories? Stock prices went down, manufacturing activity was lower. What's happening here in the KVDs? What's really changing? Yeah. Yeah, the growth expectations are probably a little lower because the manufacturing index was a negative surprise down. And so therefore, with a little bit lower growth, go back to this, PEs come down, multiples come down. When Goldman Sachs said that the average PE on the the S&P 500 index is close to 16, then assuming I knew what the return is, kind of bastardizing this, but let's say it was around 5.5%, and they said the normal PE is 13, then I knew that either the return expectations or the growth expectations were probably too high. I'm assuming it's probably closer to the growth. So that's the point. What we're seeing is the manifestation of what Goldman Sachs was saying. It's the manifestation that growth is probably going to be more tepid than people were initially expecting, given the prices of the stocks. So it's not saying we weren't going to grow. People just had very high expectations for the growth going into the first quarter because they bid up the prices. And that's the point. You have to eventually hit that growth, hit those cash flows to justify the prices. Now that's what we're starting to question, is that we just went up too far too fast, and that's the adjustment that is being made in stock prices today. And it's just happening not in sort of a cozy academic environment. It's happening in a very messy real world, not necessarily all at once, but that's the process of the adjustment that we're seeing, right, on an overall basis. So, last point I'll make for today is Warren Buffett. I was teaching a Geico case for this other class I was asked to teach. I don't really like Harvard cases because it's like case in a box. I mean, they're great, but they're sanitized, they're very specific, and you try and apply them to other cases, and they don't always work well in the real world. So that's why I like dealing with messy. And the problem with messy, then, is you never get the same answer twice, but at least you kind of figure it out. You get the answer like 7 out of 10 times. But in any event, the Geico case was about Warren Buffett buying the rest of Geico, and one of the reasons in the case was, why did he buy Geico? And part of the answer had to do with his comment that when he invests in a company, he understands their intrinsic value. And when the market, in his opinion, has it wrong, that's when he pounces. So the idea is intrinsic value is the result of the key value driver formula. Warren Buffett kind of knows, here's the cash flow I think you're going to earn, and here's what these cash flows are worth to me. And then here's the price the market is trading. When I see that the price is less than what the cash flows are trading at, that's when I buy. So you go back to the examples we talked about, whether it was Heinz, whether it was IBM, was one of his recent investments, whether it was Exxon, whether it is, who else is it buying? What else we talk about? Burlington Northern Railroad. It's all about, he believes they were mispriced long term based on his view of the key value drivers equation. This is the intrinsic value. There's the market prices. Eventually, the two are going to sync up, and one party is going to be right or wrong. Historically, Warren Buffett believes he's been more right than the market because the market isn't as efficient as we think it is in the short run, right? And that is a way to think about investment. But if nothing else, with the short run data, we still have to figure out what is the market thinking to get the short run data, and this helps us understand that. So we will pick up here on Wednesday with EIC.